Ladies and gentlemen, please welcome your panel on the Hedge-Fund Shakeout, moderated by Editor-at-Large for Bloomberg Television, Eric Schatzker.
Ladies and gentlemen, good afternoon. Welcome to the Hedge-Fund Shakeout. As I mentioned, I'm Eric Schatzker. I'm an editor-at-large with Bloomberg Television, and it is my pleasure and distinction to be your moderator for this panel discussion. Shakeout is a nice way of saying struggle for survival. A few years ago, Dan Loeb colorfully called it the hedge fund killing fields. As with any struggle, there are winners and there are losers. You'll notice that Richard Perry, Eric Mindick, John Paulson aren't on stage, though they had good runs while they lasted. That's because this panel is about winning. These five people know what it takes to win. Three of them are veterans and survivors of the hedge fund shakeout. Eddie Fishman of D.E. Shaw, Jeremy Schiffman of Palestra, Gerald Beeson of Citadel. The firms they're running, as many of you know, are thriving. John McCormick of Blackstone is one of the world's largest and most powerful hedge fund investors. You could say that he plays a decisive role in who wins and who loses. And no struggle for survival would be complete without a weapon of choice. That weapon is human capital. And no one knows how to find hedge fund talent better than Ilana Weinstein. She's the founder and CEO of the IDW Group. So let's get going. Many of you sitting in this audience or tuning in from around the world may think the key to hedge fund success is obvious. Duh, returns. Except that's not really true. And it's the first question for this panel. Why aren't good returns enough to survive the hedge fund killing fields? Eddie.
Leadoff position. Ultimately, what we're all trying to achieve is to produce performance for our investors. But as Eric says, it isn't enough. And it isn't enough because if you do it once, there's no guarantee that you'll do it again. That's the legal disclaimer that you see on all of the legends that are on the materials that we all put out. But what is required to keep going, to sustain yourself, is to have a process by which you can keep doing that. And that includes human capital. It includes lots of different things about running a firm that are not limited to the hedge fund industry, but they certainly apply to the hedge fund industry. And that's a lot to do with people, but it's also a lot to do with running an infrastructure and managing a technology organization or borrowing money or lots of different things. And so ultimately, it takes a variety of skills and a process of continuing to get better at each of those things in order to sustain yourself.
You know, it's interesting. Returns are obviously paramount. But at the end of the day, those returns are the sum total of the people behind them. And I am always surprised by the level of habitual underinvestment in human capital in this business. And I'm speaking broadly, because there are 10,000 hedge funds and $3.3 trillion under management. But the reality is, I'm sorry to say, most founders are just not great managers of people. It's not the skill set that made them successful in the first place, right? They were maybe great investors, and a fund kind of grew up around them, but now they're managing something that's more than a P&L. They're managing a business, and that means they're managing people, process, and culture. And there's a lot of things that I think they should be paying more attention to. I think, candidly, these are questions that, you know, when LPs do their due diligence, they probably should be pushing on and asking, and I wonder how much they do. Questions around what sort of clarity is there regarding how your people are measured? What kind of training and development? How thoughtful are the performance reviews? And I think if a founder is really doing a good job on that front, he almost has to visualize himself as a doctor wearing a white lab coat with a stethoscope with respect to how he's tinkering with improving his people. Things around recruiting, structuring, and building a team, helping his people with that. Helping them better navigate within the investment parameters that he set for them. If some firms, many of, actually including most of this panel, all of this panel, has done a great job, some firms have done a great job of investing in infrastructure, technology, all the things that Eddie was just talking about. And you want to help those people to better use those tools. And then finally, as they become more senior, as they become PMs or partners or sector heads, help them with respect to portfolio construction, which is really, really difficult in this, in this sort of new paradigm. How to diversify their book, how to size, how to hedge, how to manage volatility. And I just think these are things that are so important. And I don't know that founders really focus on them as much as they should, but again, in an environment of compressed returns, because that's what's been going on over the last 5 years, it's so important, or you'll lose your best people. And to the extent you do this well, you create synergy with them, where they feel they're better for being at your firm. So anyway, I just think it's a really important point that's often overlooked.
Hey, Eric. I guess you used the word necessary, or is it enough? I actually think of it a little differently, which is the returns are table stakes. At the end of the day, you have investors who have entrusted their capital to you. You need to perform year in and year out. And I absolutely agree with Eddie's points in terms of all the different components of that come together. But ultimately, talent is attracted to your firm when you're part of a winning team. And so I do think it's necessary, it's table stakes, because ultimately bringing the attraction of capital, bringing the attraction of talent, you need to produce returns year in and year out. Everyone wants to be part of the winning team.
Yeah. Can I say, Eric, my initial reaction was
Don't need to ask for permission.
Great returns are a heck of a good way to start. It's a good place to be. I think the definition of a great return is different for every institution, and what most of our institutional clients are looking for are returns that don't have equity market beta in them, so you don't have a lot of market exposure, downside protection in a tough market environment. So it's a lot more complicated than just putting up a good number by having exposure to some beta. You got to deliver that in a package that comes with terrific risk management, lots of diversification, and exposure to markets that people aren't picking up other places. When you try to put those 3 or 4 things together, it's a lot more complicated than just putting up a good number.
Well, I started the conversation off by making the assertion that it's about more than returns, and there's some consensus to that effect, but inevitably, as you point out, Gerald, it does come back to returns because you can't play the game, unless you've got the returns to show for it. The reality, of course, is that the returns, broadly speaking, aren't as good as they used to be. Jeremy, what do you think? Well, first of all, is the supposition that that alpha is harder to generate than it used to be true? And if so, why is that?
I think if I speak for our own firm, I'm not sure I've seen a massive change over the last number of years, but I think for the industry, that's been the case. That is empirical. If I put my industry analyst hat on, I cover financials amongst some of my other responsibilities and cover the asset management industry. And so as you think about some of the tailwinds and headwinds that hedge funds are having, it's true in long only, it's not true in private equity right now, but those are also stocks that I would pull into this universe. And the reality is where we are in the hedge fund industry is similar to what we've seen, I think, in the long only industry over the last many years, which is it has matured. There is little structural alpha, if any, right now. And so what that means really is that there's not a participation medal for showing up at a hedge fund saying, hey, here's what my alpha return is. It becomes, I think you alluded to this a little bit, Eric, a little more zero sum, which doesn't mean that there's not winners and losers. There's an equal number of winners and losers. And in many competitive games, and you take sports as an example, there's There are winners who are consistent, predictable, repeatable. In tennis, which is a very skill-based game, Federer seems to come on top more often than not. And I think that comes down to the conversations we have with our investors, which is the game has shifted a bit from being a question of asset allocation and how much you allocate to the asset class, particularly for equity long short, because it's not an asset class in and of itself. It's really a funding vehicle. You'd say equities are the asset class, perhaps. And the great thing about it, from my standpoint, is there's not an asset class return to equity long short. You can be long or short. You can be in different sectors and whatnot. But finding managers and building an organization, as Alon and Gerald alluded to, I think is part of the challenge. And so it becomes, again, one of manager selection. And if you start with a supposition, which is, I think, fair, that you're not going to have a superior performance by investing in the index, then you really need to concentrate. And so, John probably has good perspectives on this, but our conversations with investors have been they have to find the managers and they really have to pull and pick their spots and really concentrate their bets in order to drive that outperformance.
I think it's actually worth taking a moment to understand where we are versus where we were in terms of why the structural deflation has happened. So when I started my firm, it was 2003, and there were 3,000 hedge funds. Now, as I've said, there are over 10,000. There was 500 billion of AUM being managed. Now there is 3.3 trillion. There was far more liquidity. There are fewer publicly traded stocks today than at any point over the last 40 years. There's 3,500 versus 8,000. Mutual funds in retail have shrunk. And by the way, there's no incentive really, right, to go public today because of all the increased regulation and scrutiny, and tech PE firms have become massive, so you can fund that growth privately. Also, you have the advent of so much capital going to the better platforms. So as a result, you have more eyes, ears, and GMV at these conferences. So think about it. If Disney management says something squishy, you could be short for 3 to 6 months before that would be priced fully. Now that gets priced in 2 days. And so in this environment of diminished opportunity, you have all this money at funds being levered, trying to find alpha. And to pick up on Jeremy's point about zero-sum game, alpha generation is a zero-sum game. And that means if I outperform, somebody has to underperform. And to the extent that quant strategies are extracting some of that alpha out of the market, that's coming out of someone else's pocket. So you can, and talent at the end of the day, who's in this industry? This industry is comprised of business and industry analysts. That's what they do. So you can bet your bottom dollar that the same way they're analyzing companies and figuring out how to monetize that, they're also looking at the dynamics at play in this industry and figuring out how to monetize that for themselves. And and to some extent, looking at the hedge fund industry as a giant poker table. And they're asking, who's going to lose? Who's the sucker? Who's going to lose? And they don't want to be at the places that are not poised to win. That's a little bit of sort of a purview from my seat.
Ilana introduced one of the elephants in the room, and that's quant. Who wants to take that on? The degree to which quant is responsible, not just for the erosion of alpha, but the hedge fund shakeout itself.
I'll take it. I guess when I think about this issue, they're really competing at two different ends of the spectrum. So ultimately, when you think about a typical quantitative firm, they're more focused in terms of what is the mosaic of information for analyzing a host of security prices in a short period of time. If I'm thinking about what can't a human do? A human can't look at that mosaic of 2,000 securities, and here's 2 that moved in a certain direction, and the resulting effect should be this one to move in the opposite direction. That's ultimately a problem that's going to be solved much more by the predictive analytics, more the machine learning and quantitative type techniques. When I think about our business, the pure play fundamental research business, that's about thinking about the longer term horizon, whether it be the next quarter, 2 quarters out, longer than that, ultimately in terms of taking information, which has changed today in terms of the way that information is synthesized, no doubt, in terms of the amount of information, the way that gets processed, how it drives through in terms of the analyst processes that they use for ultimately making calls on stocks. but they're different in terms of thinking about the fundamental research that requires the skill and the judgment of the end investor. And so ultimately, that's not replaced by a machine, because ultimately, if you think about the context of a situation like Brexit, there's no machine necessarily that'll be able to say what was the context of this event in the portfolio. That still ultimately requires the analyst to be able to think about, here's the mosaic of information I have, and then against that backdrop, what is the judgment call I need to make in terms of positioning my portfolio?
Maybe just to build on that. I agree with everything Gerald said. I would say it is true that quantitative techniques have transformed the industry. That's true within finance. It's true in other spheres of human existence. I think within finance, it's true of the hedge fund industry. It's true of proprietary trading. It's true of the sell side. I guess from the perspective of what effect does this have on the availability of alpha for the investor community, it's not obvious to me that the effects of quant have been more pronounced than what's changed in the discretionary investing arena. I mean, it's not the case that alpha in the quantitative arena has declined, whereas it's remained awesome in discretionary. I think it's been challenging in both communities. To take a step back, I would say, to build on some of the structural things that Ilana referred to, the market for alpha is like any other market. It's a function of supply and demand. And there are so many things that have changed structurally in the market over the years. After the financial crisis, I mean, society wanted a smaller, simpler, less levered financial system, and it got that. It got Dodd-Frank, it got the Volcker Rule, it got all of these things that have constrained the ability of the banking community to provide liquidity to the markets. And it's most pronounced in fixed income and currencies and commodities and credit. We've seen a 30% reduction in the big US banks anyway, participation in FICC. And that affects our marketplace. It affects the, at first blush, it might have seemed that it was going to be great. There were going to be fewer bank proprietary trading desks to compete with. But what it also meant was less client facilitation, fewer instruments traded in the ways that Ilana was describing. And so that means fewer tradable opportunities, more constrained supply of alpha. On the demand side, the further we get from 2008, the more investor portfolios look like what the investors want them to look like. There's less overhang of illiquid portfolios. There's, people are full up on public equities. They're full up on sovereign rates. They're full up on private equity. They're not looking to add to long, risky assets. And so there's such a pressure for uncorrelated returns. So on the demand side, you've seen tremendous pressure too. Is that from the quantitative orientation? Yes, but I think it's not limited to that. I think it's broader and more structural than that.
I think it's hard to deny the massive impact of quant, and we're big allocators to quantitative strategies. I think, Gerald, you made a great case for the fundamental input and the human input to alpha generation. But the firms that we're seeing being most successful that are still relying on humans to generate insight are firms that are increasingly adopting quantitative tools to facilitate that human insight, whether it's new data sets that they're using and statistical techniques in the alpha generation process, or better portfolio construction so you won't get carried out by some factor unwind or by a crowded trade, or through better trading technologies. Whatever strategy you're executing, whether it's strictly a quantitative strategy or whether it's still a more basic fundamental strategy, the adoption of quantitative tools is changing the industry across the board, and by and large, it's a positive development.
So is that to say it's not an either or, but an and?
I think for some firms it's an only, right? That's the way they generate returns. But I think for firms, there's still a role for humans, of course, in figuring out regime change, figuring out disruption. But those humans tend to do better when they're enabled with quantitative tools.
Right, but I guess, John, to that point, I think of it from the standpoint of quantitative tools that enable the fundamental investor, as opposed to, I think, probably where, think about Eric's question early on, is there's the pure play quantitative manager taking away opportunities from the fundamental. I don't think that ultimately that is the case. I think that certainly, at least looking within our four walls, it's the tools you can bring to bear, as you point out, portfolio construction, the way that you synthesize information and making the various inputs to your model for making a forecast on security prices. But that, again, is, I think, enabling the fundamental investment process through quantitative techniques.
I think there's also an element, and Gerald, I love your perspective on this, but at the better multi-managers that have a enormous fundamental long-short equity business, for example, and they have captured a big piece of the market share in terms of the best analysts and the best PMs, they have, I think, created something of a cabal of really of insights that just a quant fund wouldn't have. Because the thing people don't know is buy-side positioning and consensus. And if you have 25 analysts covering Netflix, you have a view of all of their buy and sell recommendations, sizing, estimates, the PM's treatment and trading, and the average quant fund maybe can get access to some, I don't know, some guy sitting in Indonesia, building a model on Apple, but he doesn't have access to that. And I think to some extent, it's building the greatest information machine of all time. And yes, I do think the sum is greater than each of its parts in terms of mixing this sort of fundamental input and quant. And quant, of course, can make, I think there's also the making humans better in terms of being able to manage shorter-term volatility more effectively.
Yeah, maybe just to add my 2 cents. I mean, quant is a big word, and I think most fundamental investors probably did well at math and would view themselves as somewhat quantitative as people. In our experience, in our day-to-day, I don't think we come across, said differently, if we struggle from an alpha standpoint, we're typically not blaming quants in the machine. We have, for ourselves, a relatively concentrated portfolio, 20 longs. Our top 10 longs will account for 55 to 60% of our risk. And our time frames are, on the longs, yes, we will sometimes look at 6 months moves, but we're really looking a year or 3 out. And there's a lot of quantitative elements that go into that. We talk about data stuff, we can talk about portfolio construction, we can talk about how you think about sizing and using tools. We have a very quantitative framework for thinking about that. But that is different than a quant fund, which has 500 longs, 500 shorts, and is working a certain factor on a 2-month look. Or maybe it's a stat arb fund that has a 7-day window, or a 1-day window, or an HFT fund that has even something inside of that. So I think people do feed on different leaves in the ecosystem, if you will. The biggest issue we have, I think a little bit is alluded to just simply the survivorship bias in the industry, is that some folks who leave the industry may have been a source of alpha, now they're gone. And so it's really, who are you competing with? And John, you're probably in a better seat than most to look at this, but it's not as if the returns of quant on average have been great over the last, call it 15 months. I think there are also winners and losers within that, and it's about innovating in that game. In a sense, for all the issues that crowding on a fundamental side can be subject to in terms of big tech exposure or pick your spot. From a quantitative standpoint, if you think about small data, or call it market data, everyone has that market data. Maybe some people buy a little more information on depth of book and whatnot, but they're all working with some of those things, and they're back testing, and they're using those algorithms. So it's not as if to say, that is the answer. The grass to some extent might be always greener, but if I just look at the returns, that's not an obvious place of greatness. It really still comes back to this manager selection, I think.
John, do you want to take us a little further down the scientific rabbit hole? I'd like to know.
You're asking the wrong person, Eric.
No, I suspect other people have a similar question. Is the pursuit of, let's call it advanced technology, the pursuit of big data, the pursuit of applications for machine learning and artificial intelligence, a never-ending arms race that only the biggest firms can win?
Well, I will tell you just empirically, the firms on our platform that have performed the best are the larger firms. There's been a positive correlation for the last several years between size and positive performance, returns, and alpha generation.
One that you think can continue?
One that we think will continue, but that's not just quant, by the way. That's we haven't talked about mortgages and some of the other opportunities that the banks have been giving us. I think the really interesting question for quant going forward is what impact artificial intelligence and machine learning will have on the strategy and on the industry as a whole. If I think about quant today, it's incredibly sophisticated. It draws on a lot of market data, as Jeremy pointed out. But a lot of it is based on human intuition about how markets ought to work, a lot of research and some very good statistical work. AI and machine learning is not based on human intuition about how markets ought to work. It's based on analysis of massive amounts of data, bottoms up, and a machine building a model to predict the outcome of a stock that may operate on a logic very different from how a human would think about it, and that a human may actually be unable to explain. So as we move forward into this space, it raises a lot of questions about exciting questions about the possibility for return generation in different ways. I think it raises the possibility of disruption for some existing strategies. And I think for allocators, it raises a number of difficult questions about how you'll do due diligence on models that the creators or the humans running the firm have difficulty explaining.
Eddie, data science has been at the core of what D.E. Shaw does since the very beginning. So how are you thinking about this? How is your firm thinking about this concept of, do you see it as an arms race? Is it, does the amount of money that you dedicate to pursuing, let's call it advanced technology, grow inexorably every year?
Some things have changed. Other things have remained the same. I mean, when we started the firm 30 years ago, I would say a lot of the quantitative models that we were trading were probably trading against human discretionary investment managers on the other side at the end of the day, on average. But market structure has changed dramatically. And typically, for the last many years, we're probably trading against other quantitatively oriented products. And those can be sell-side execution algorithms or lots of passive participants and lots of other things. So in some sense, quant and the rise of quant and the impact of quant and the amount of R&D going into quant has been rising for decades now. There are some things that have changed. There have been a few panels here at the conference on the impact of AI and some of the advanced techniques that have been developed. There's also developments in computing power, and so things that were inconceivable years ago have become more plausible. So I do think that the standard is rising. It's tremendously competitive, quant and otherwise. But within quant, the standard for what it takes to compete has been rising. We shared with our investors in a fall conference the observation that in some arenas this is referred to as the Red Queen race. In biology, this is the observation that it's the theory that sexual reproduction can allow recombination of DNA that allows species just to maintain parity with the developments in their environment. And it ultimately comes from the Alice in Wonderland story, where Alice meets the queen, and she's running, and she isn't getting anywhere. She comes back to where she was, and the queen said, well, here, you have to run very fast just to stay in the same place. If you want to get somewhere, you have to run twice as fast. And I think that is what's going on in the quantitative industry. So Alice predicted it. Lewis Carroll predicted it.
Gerald, John raised the point that, at least from Blackstone's perspective, the larger firms have been performing better. Citadel is a large firm. How do you use scale to your advantage?
I think a few different ways. One is just in terms of thinking about the building of competitive advantage. And so you're kind of harkening back to the earlier question, I think a bit about returns as being what powers the flywheel. And so ultimately, returns empower your ability to be able to invest in talent. Talent allows us to be able to invest in a diversified business. And then ultimately, the technology powers that business, the innovation that we deploy across each of the underlying businesses, and then from there, kind of enabling your returns. And so from that vantage point, it is, I think, incredibly important in terms of the scale we've been able to generate over time has allowed us, I think, to be able to continue to perpetuate that across the different, all the different silos that we run.
Yeah, I think just to add on that, to some extent, the question of scale, I think, comes back to what your strategy is. If you're a concentrated manager, having too many people can actually be a decent amount of deleverage. I mean, one thing that we think about, it's maybe a funny way to say it, but is the success of your firm driven by the sum of the IQs in your organization or by the average IQ? So should you go out and hire a bunch of people? Do 300 IQ people equal Einstein? No. So if you have 20 longs and 40 shorts, then you're really focused on a set amount of sectors. You really want to keep the decision making with the highest average IQ that you can. And that's been our process. There's another dynamic there, because it's interesting to hear. There's no obvious common wisdom. And in fact, most of our investors, we're very involved in talking to them about what the scale of funds it is that we can manage. If you have a team, a strategy that can create $300 million worth of alpha, and you're a $3 billion fund, that's a great number. If that's a $10 billion fund, the number's not as good. So to the extent you have a scalable strategy and you can add on compute power, you can add on people and teams, and you're feeling around that edge of where you start having this alpha decay, I think that's a question. But it really does come back to one of strategy. For longer term, more concentrated managers, I'm not sure that's the case. And I don't think, and we can get into this if we talk about big data at some point, but I don't think we're really competing with the same signal intensity on some of those shorter term signals. The questions are a little bit different than we're asking. It's not to say quantum computing can't compete at some point, but that's not really the game now. It's really more what I think was spoken about, and I think Gerald raised this too, of having technology enable talent to drive outcomes. And technology and big data is actually a very positive thing for active management generally, because it's enabling a new discussion and a new change that's enabling for more winners and losers structurally. That's kind of what we're looking for.
But Eric, I think another point with this is, it's what does talent bring to an organization when you operate at scale? It's that it moves quickly beyond, and I think Ken Griffin made this comment earlier today with Michael Milken, it moves quickly beyond the founder's capability to manage just the one business or the one geography. You become dependent on other people in the chain. And what that enables you is to be able to bring more people into the firm, empower them to be able to have an earlier point in career development in terms of how they take on responsibility. It allows you to pursue different business opportunities than you may have if you are a more concentrated executive team. And with it, just the scale of your aspirations grows as you're able to incubate, grow, and develop that talent.
I just want to add that I think whether it's a big firm or a small firm, you talked about sort of, your comment was sort of the average IQ or having the highest IQ, right, make the decision. One thing that I think is really important, and particularly single manager funds, and you and Andrew have done a good job of this, but many funds do not do a good job of, they have somebody at the top who is the ultimate arbiter of the decisions that get made in the portfolio, and even multi-manager funds. I think this is also something that PMs, the various PMs, need to be aware of, which is to marry decision-making as much as possible to the people closest to the idea. I also think it's it's one of the biggest reasons people leave, which is that they run out of runway. And I'm not suggesting that somebody take a kid who's 3 years out of the investment banking program at Goldman and give him the reins to make decisions and run the fund. But you need to, there are things you can do. You can, after 4 or 5 or 6 years, if you have done a good job, which is an if, but if you have done a good job of vetting, training, and developing your people, you should be giving them maybe the ability to make a 1% decision with autonomy with respect to their positions, or maybe you give them a couple $100 million to manage, and look at what they're able to do over a 1, 3, and 5 year basis. Look at the alpha that they're able to generate, candidly, even relative to yourself, and to the extent they're doing better, you shouldn't be afraid to actually push decision-making, capital, and economics to those people. Because if you are so lucky, first of all, it'll probably improve the returns of the fund. And if you are so lucky as to be able to be growing, you really can't manage more than 5 or 6 investment professionals, because you can't be in the weeds in so many different ideas. And if you're running a fund with 90 positions, the truth is, after maybe it's the first 40 that matter. The second 50, you can let your people see what they're made of and see what they're capable of, because the 70 basis point short really isn't going to matter in terms of moving the needle for the portfolio. And I also think it's important to make your people accountable. One of the biggest complaints when people get into my office is a lot of sort of distress over the fact that they can't effectuate as much with respect to the portfolio, as much with respect to what goes on in the portfolio as they would like. So knowing that they're complaining to me and to my team, I think one of the smart things a founder can do is to get in front of his people and say, get in front of your best people and say, okay, big shot, you think you drive value? Terrific. Drive it and own it. And you think I should be putting something in the portfolio that I'm not? Why aren't you in my office daily or weekly and convincing me and showing me the logic as to why I should do that? You'll empower your people and you'll make them more accountable. And I think it actually will improve the returns of the fund as a whole.
I think I need to channel, excuse me, the cynicism of the audience for a moment, because the cynics would say, come on, like, does that soft stuff really matter? Surely those people, the successful PMs who get up and leave their seats at hedge fund A and move to hedge fund B are doing so mostly because they want more money.
Okay. I'm not going to debate that point because that's not untrue. However, let me give you a little vignette, which literally just unfolded a few months ago. Obviously, no names or even approximations of who this could be. So at year end, we are always talking to people about what they think they're going to get paid, what we think they should get paid, and usually, I've been doing this a long time, my margin for error is pretty small. I come pretty close to they always think it's going to be higher. I sort of am more the voice of reality, and usually it shakes out closer to what I tell them. So this is a fund, as we've talked about, the last 5 years have been difficult. This is a fund for whom things have been particularly difficult. And this is a guy who, again, by the way, as a side note, may or may not surprise you that it is the same people, for the most part, year in, year out, in spite of the sort of depression of returns here, that have managed to outperform within their funds. So he tells me, and he has triple-digit P&L for yet the 4th or 5th year in a row, multiples of that, in fact. He told me what he thought he would be paid. I told him there's no way, there's no performance fee, there hasn't been for a while. I gave him a number. So come January, whatever it was, 15th, mid-Jan, he calls me up and he says, I just want to let you know what I was paid. So I thought, here it comes, the terrible number I told him. And he told me the number, and it was actually mind-blowing. And I was impressed with the founder in spite of myself, because it was exactly what he should have done, which is reach into his own pocket and pay the guy what he deserved. And I thought he was sort of calling me to a little bit rub it in my face, like, you know, I told you so. And then he said, so I actually want to come in and talk to you as soon as possible, because now we need to be thinking about my next step. And the reality is, it's not just about the number. It's about a whole host of other things, because nothing else has changed other than he got paid what he should have. And the other things that are paramount, and it all has to work in unison, is one thing you touched upon in your opening remarks, Eric, which is stability. And that is not something to be taken for granted. You mentioned, I think, Eaton Park and Perry maybe, which was when I think the wheels first started to fall off the bus, which was like 3 or 4 years ago. In this last year alone, we have had more big funds close than ever before. And that's meaningful because, you know, we always hear about the small fund that can't scale, but to have funds that opt to sort of take their chips off the table, like Blue Ridge, like Highfields, a host of other big funds that had to close that had been around for decades and were in the billions, says something about the structural sort of changes in this industry. So that's number one. Number two is netting. And so that is to compensation. Your best people have to figure out a way to pay them. And I think as a founder, you need to be willing to look your people in the eye and tell them in any given year, I'm willing to go to zero if you drive the value. And you can guess how many do that. The other thing is giving them a pathway. You know, there needs to be, to a point I made earlier, there really needs to be a way for them to continue to develop and evolve. There needs to be runway. They need to feel like they are not a cog in a wheel where they are, but that there's a real career path. And that doesn't necessarily have to mean, it used to mean once upon a time going out and starting your own fund. which is obviously very difficult. And so I think, again, the better multi-managers have stepped in big time and aggressively to fill that gap.
Ilana, you've touched on an
Yeah.
important point, which is, not just what firms, the survivors do well, what the winners do well, but what the losers don't do well enough. And I think it might be useful to put this question to you, John. If you look at the hedge funds that are floundering or that have failed, what do they have in common?
That's a great question. I do think that the ability to attract and retain top talent is a critical issue. And for firms, very often there are firms that really are all about one person or about the founder.
Founder manager.
And those firms can work for a long time, and there are brilliant people who can carry that off. But I think the very best firms, and I think a way to reduce the risk of firm failure, is to attract other talented people, because nobody's got a monopoly on the right way of investing for a particular market environment. So what does it take to do that? It means you have to build an organization where where economics are shared, where there's some transparency about what it takes in order to be rewarded, and that transparency is built around an incentive system that makes sense and that creates longevity in an organization. It often means that, to come back to your cynicism, that people might want to maximize their compensation, but it doesn't mean they have to maximize their compensation in the next 10 minutes. There are a lot of people who take a longer-term view and care about personal development, care about career development, care about the possibility of being exposed to things that they haven't done yet because it's intellectually interesting and also in the long term rewarding to be able to do a broader range of things. So I think a big part of what makes a firm successful in the long term is the creation of an incentive system and a culture that attracts additional talent beyond the founder, provides the firm with some resiliency, and provides for an exchange of views that leads to better outcomes.
Can I build on that, Eric?
Yes.
We've all had careers where we've seen, where we made our own career decisions, and we've seen the decisions of our friends and colleagues. And over the years, it's been interesting to see what paths people took, and maybe they took a different job because they were enabled to go from the assistant head of X to the head of X at some other firm, and or maybe they didn't. And I guess something that I've observed anecdotally that matches with a few of the things mentioned earlier is that, by and large, the people who have gone to a bigger job in a less challenging environment for a short-term increase in ostensible responsibility and sometimes compensation typically haven't done as well as the people who have stayed in more challenging environments. And it took a colleague of mine to kind of put a theoretical framework around this for me. And everybody says it's human capital, and that's right. And the key word here is capital. And the returns to human capital compound just as the returns to financial capital compound. So to take Jeremy's earlier example, where you have multiple people with a certain average IQ or whatever, I'll add a little math to it just to spice it up a little bit. If two people intrinsically would each get 10% more productive per year, if they're on their own, they'll achieve that 10% productivity increase. You put them together, and they get that much more productive. It's 1.1 squared in this case. And so they get even more productive. And with many, many people, extraordinarily talented people, together, that human capital return compounds over time, and you can achieve tremendous outcomes. So I guess the main point is, in these career decisions, the people who tend to do the best are people who challenge themselves by surrounding themselves with other people who will make them better. And so if you are not in an environment like that, if you are an extraordinarily analytically minded person who's commercial and motivated and a clear communicator and numerate, and you aren't inspired and challenged by the people around you, go to deshaw.com. We'll tell you if we can't help you.
So wait a second. Same question for you, same question for you. When you lose people, when you lose good people that you regret losing, is it because they wanted to do more or because they wanted to make more?
For me or for?
Both of you.
I mean, it's thousands of people over the years, so it's, you know, people's utility functions are heterogeneous. Sometimes they want to go back to academia. They want to just do something different. Sometimes it's because their friends started some firm in some other place. And sometimes they perceive a better opportunity out there. Or they want to change fields. They want to go start Amazon. They want to do whatever they want to do. So it's very hard to generalize.
No, I mean, I agree with Eddie's comment. I think ultimately, different people have different utility curves. Ultimately, they're going to make a decision in terms of, do I want to think? We've had very few people who've ultimately left to go create their own firm. We've had a handful over the years. But largely, I think about why do people come? And so I kind of go back to my own story. I started at Citadel as a 21-year-old accountant. And so ultimately thinking about how I was able to grow at the firm over time, you bring together in terms of collections of people that are moving very quickly. You're trying to be able to keep up with that. It ultimately causes your career development to move at an accelerated point that you probably never could have fathomed. And so ultimately, I think that's ultimately when we bring our people into our four walls, it's the ability to work in challenging problems and opportunities you may not have been able to work on outside of finance, and to do it with the brightest people in the world.
Just to take this in another direction for a second, we've talked a lot about talent. The key constituency here are clients, with LPs. And I think that is the other mistake that firms make. If you view your LPs as a source of capital instead of as partners, I see a lot of firms go wrong that way. If you truly view your LPs as partners, you're going to have deeper conversations with them about what it is they're trying to accomplish, which means you'll be much better positioned to address those things. And when things go wrong, as they inevitably do in this business, you will have built up a reservoir of trust and goodwill that will put you in a position where you can work out of it in a way that makes sense for both parties. And I think talent, incredibly important constituency. You have to have the best talent. The way to have really great clients is to invest in those relationships and make it a partnership and not an extractive kind of relationship.
Part of that, too, in having that kind of relationship is to be able to speak to your LPs about making tough decisions and firing people. Turnover is often a dirty word in this industry, and I find that founders are reluctant to make tough but obvious decisions because they're afraid of the optics of firing somebody who's been maybe, they're already challenged in terms of their returns. They don't want to rock the boat by firing the very guy who's maybe responsible for a lot of the bad ideas that go into the portfolio or the decision making that drives down returns, only to have the winner come into my office and talk about how frustrated he is because he can't get paid because of the netting thanks to this guy. And the reason the guy isn't fired is the founder's afraid of rocking the boat. So I think that when we talk about building a culture of excellence, that's also a big part of it. You need to, that'll get rid of netting, and it'll also be a place where it's clear that you really need to be excellent in order to have a seat there.
Should we try to build a consensus on that point? Should hedge funds be firing more people? Jeremy's going to take this one.
I think it's a mix. I think having been in private equity in a couple hedge funds and now having my own firm, there is a lot to what Alana says. To the extent you get a buildup of dead wood to clear out that wood, and it really can open up the culture. And it's an interesting thing about, I'll take the private equity experience I had in the past. What type of business can have fat? It's typically a pretty good business. That's the type of business that can allow still reasonably compensated people to be there and still not really perform. If you're very entrepreneurial and just starting up, there's not even space for that. And so I have observed that has been very helpful. I think it needs to come back to some type of review process that you're tying back to culture, and are they tying into values, and are they driving performance? And that helps you either coach someone to get better, and that can happen, or you can see that coaching's not going to help, that they might have the values, but they're not going to have the commercial aspects, and then you have to have a conversation to move on. And what I have seen is sometimes they're going to do phenomenally well in their next seat, and you're all about enabling that seat for them. And so I think you can have very frank conversations about where they need to get to and some time frames, and I think those can be done very well. And what can happen then, I think, is they can be some of your biggest supporters in what we'll call the ecosystem outside. So handling those conversations is important, but I think it's particularly for a firm like ours, which is a pretty tight boat, you feel the move in firms structured like us of everyone on the team, and you got to get the alignment, and everyone has to be doing their job. And so, coaching and counseling out are both parts of the game.
Well, you guys have had great returns. You've basically had double-digit returns almost since inception, so that's working.
Well, thank you.
But LPs are getting pretty aggressive about firing their hedge funds as well. So, I think tough decisions need to be made in order to sort of raise the bar across the industry.
Eric, taking a different direction though, I think ultimately if you look at in a firm, what are you selling in terms of when you're across a prospective employee? You're selling that there's a greater opportunity for you to be here in this seat than the seat that you're in today. And with that, it's what do we talk about? Is a culture of meritocracy. And so you're going to give people the opportunity who prove that they have the capabilities to be able to rise to the occasion. And with that, unfortunately, it does create from time to time that you have to have a tough conversation with someone else that's time to move on. And those are obviously unfortunate conversations to have, but they're necessary. And if you're ultimately going to run a high-performance organization, you need to make sure you have the absolute best people in your firm.
Or just to build on that, I don't have much of a view on whether in the aggregate hedge funds ought to be firing a higher percentage of their staff or a smaller percentage of their staff. But just to bring it back to the sort of the title of the panel on Hedge-Fund Shakeout, and to refer to something John said earlier, I mean, these are the sorts of important questions, tough decisions, as Ilana said, that are the lifeblood of any successful organization. And I think that one way for LPs to engage with their managers and to have the sorts of relationships that John was referring to, is to observe that the stronger firms in this industry are extraordinarily well-run firms. I mean, to be able to sustain the level of excellence over a period of decades is an astonishing accomplishment. And I think whether it's asking Gerald how he borrows money from banks, or asking any of the leading firms about how they approach some sort of generic management problem, a personnel problem, an infrastructure problem, is a way that you can further your relationship with your managers. These are the stronger run firms have had to adapt in many ways that go beyond trading and investing.
Mindful of the time we have left on the clock, I would like to ask every member of the panel one last question, which is share with us your view or vision, perhaps, of what the industry looks like 10 years from now. And we'll start from the far left. Jeremy?
I think we talk about hedge funds specifically, and whatever structure that means. I think assets are over 10 years higher, because I think asset returns are going to be there. I think fee structures overall are lower, so revenues at some delta from that. And I think there will be a fair amount more creativity and alignment on what those fee structures look like in terms of paying for the skill that you're providing.
Ilana?
I think there's going to be further consolidation, both with respect to AUM going to fewer funds, but I also think as a result, there's also going to be more consolidation with respect to talent. Talent is getting more and more frustrated, the same way LPs are getting frustrated, and they are going to effectuate putting that into action and leaving and going to places that they do perceive to be the winners in this paradigm. I also think that as it's become more difficult to start a fund, the pathway of leaving and going to a multi-manager becomes more attractive. But I also think that in a strange way, there'll be more talent, because I think they'll end up going to places that have a better institutional process to making them better. And there'll be a new generation of talented investors that grow up at those places. So I think in the end, we'll be in a better place in 10 years from now.
John?
I think the term is actually doesn't mean very much today. I mean, we're allocated to everything from 1,500 mortgage servicing operations to quantitative strategies to global macro and long-short equity managers who are fighting it out every day in liquid markets. The beauty of hedge funds is that they are eminently flexible. They go to wherever the opportunity is. I think the only trend I'm confident in is we'll have ever smarter investors who are going to disaggregate returns, understand what they're paying money for, and the bar will go up every year. But I already think the term is so overly broad that it doesn't mean very much.
Eddie.
10 years is a long time. A lot of things could happen. I think the name of the game is to prepare for a wide range of potential outcomes. But if I had to take, the central case, the base case, it would be lower percentage alpha, larger dollar alpha, a continually dynamic environment, more consolidation. Those would be some of the trends.
Yeah, I would echo that. I think ultimately we wind up in continuing on the path we are today, more consolidated, but more barbell. That you'll have, in terms of, to John's point of, in response to the opportunity du jour, you'll have more of the boutique firms that are able to pursue those opportunities, and the larger firms continue to be able to grow in terms of the massing of talent and AUM over time.
Ladies and gentlemen, thank you for joining us for the Hedge Fund Shakeout. Please join me in thanking our panelists.